The global economy is going through challenging times. As all of us know that there has been a sharp increase in global inflation, and in response to this global inflation, countries are taking various measures which includes very rapid increase in policy interest rates, withdrawal of whatever liquidity support they had given during the pandemic period, discontinuation of the fiscal stimulus policies which they had rolled out during the pandemic. And all these measures, what is happening because of the change in policies, there will be very significant impact on growth. So there is a general fear that the global growth will go down very substantially or there will be a recession. At the same time, there are also concerns that despite so much of policy measures, inflation may not come down very quickly, and for a prolonged period, it might remain above what is considered to be normal. So, either negative or low growth along with high inflation. Technically, this is called stagflation. So, that kind of concerns are there in the minds of the investors. On the top of that, there are geopolitical uncertainties. For example, the ongoing Russia-Ukraine war. For example, the periodic lockdown in China because of the zero COVID policy, and more recently the instability in Britain. So all these things together have negatively impacted the investor sentiments, and consequently we have seen there has been a large flight away from equity as an asset class across the world. And for example, we know during the current year almost 3 lakh crore of FI money has gone out of Indian equities. And as a response of all these things, there has been deep correction in the equity market. So, equity market in India peaked out in middle of October 2021. Since then, the broad indices are down almost 15%. But this is just not India, this is happening across the world. US is also down by more, and most of the countries are down by more. What is interesting is that despite so much of correction, even now Indian equities has given more than 100% return since the bottom we had seen in March 2020. So in that sense, India remains slightly more resilient than other countries. Having said that, the near-term outlook is not positive because, as I said, while it's expected that the growth will go down or even there could be a recession, so major part of that concern is already in equity prices, but it's quite possible that the market might go down even some more, whether it's 5%, 10%, difficult to say. But at least in the next 3 months, the equity market outlook does not look particularly positive. But does it mean that our outlook on the equity market, Indian equity market, is negative? No, our outlook is not negative. In fact, from the medium to longer term perspective, our outlook on Indian equity market is rather positive. Why? Because in the long term or even in the medium term, the equity market is driven by 3 main factors. The first thing is fundamental, both macro and corporate. The second thing is equity flows towards the equity market. And the third thing is valuation. If we look at all these 3 things separately, in terms of all these 3 things, Indian market or India is doing well, much better than most other countries. Let's talk about macroeconomic fundamentals. If we look at most of the activity indicators, for example, GST collection, which was just about 1 lakh crore in 2019 before the pandemic, has crossed 1.4 lakh crore. Similarly, if we look at the number of EOA bills which are required to be filed during for GST purposes, and that shows how much goods are moving around in the country, the average number has gone up almost 40% between 2019 and 2022. Similarly, if we look at other activity indicators such as electricity usage, for example, freight by Indian Railways, all these are suggesting that there is a significant pickup in activities in India, Also, other indicators like industrial production, the infrastructure indices, these are also suggesting that India is recording a smart recovery. The bank credit growth has started accelerating. In fact, it's the best since August 2019. It has crossed 12% mark. The foreign direct investment flows towards India has picked up from less than 6 billion per month. In 2019, the FDI flows to India has come very close to, on a monthly basis, $8 billion. So all these things suggest not only the current economic situation remains pretty strong, the investment activities which decides the future growth rate, those are also pretty good. In terms of inflation, inflation had gone very close to 8%, but it has subsequently come down close to 7%. If we compare India's inflation with developed countries, for example, in Germany, the current inflation is 70-year high. For example, in US, the current inflation is 40-year high. Even if we take the previous inflation, which was at 8% for India, it has come down now. Even that was just a 8-year high. So if you look at the extent of problem in terms of inflation in India, it's much lower than most of the industrialized countries. So if we look at the overall macro parameters for India, these are pretty healthy. If we look at the corporate performance, the corporate performance has been even better than the overall economic performance. The quarterly corporate sales today is more than 50% higher than the kind of sales which was happening before the pandemic. Similarly, while there has been increase in expenditure, particularly because of the increase in commodity prices, raw material prices, and wage cost, if we look at the corporate margins, despite some amount of margin compression, the corporate margins remain much better than what was prevailing before the pandemic. And in terms of profitability growth, even now we are seeing whether for Nifty 50, the year-over-year growth of corporate profitability is upwards of 40%. So actually, if you look at the corporate sector is doing even better than the overall economy. So in terms of the fundamentals, both macro and corporate, Indian economy is doing well. That brings us to the second issue, which is liquidity. In terms of liquidity, there is quite a bit of concern that a lot of money is being withdrawn from the equity market by FIIs. As I said, almost 2 lakh crore has been withdrawn from the Indian market by the almost 3 lakh crore, in fact, from the Indian market during the current calendar year. Now that is being seen as a negative development, but here there is this is not totally true. There are two types of foreign investment in India. One is through the FII route, and the other is foreign direct investment in the listed companies. So the overall foreign ownership of the listed companies, if we look at, it's a combination of foreign portfolio or FII flow and foreign direct investment in the listed companies. If we combine the both, the overall ownership of the foreigners in Indian non-promoter part of the shareholding, which we call free float market cap, that's about 55%, and this number has not changed. So while the FIIs have sold in the secondary market, there has been actually significant increase in primary investment in Indian listed companies. Again, if you look at the mutual funds, the mutual fund ownership of equity has gone up pretty substantially. There has been slight increase in the ownership even of the insurance companies. So from that perspective, if we look at the liquidity flow towards the Indian equity market remains pretty encouraging. And in fact, if we look at the data for FII flows to India since 1997, so almost this is in this 25-26 year period, only in 4 years foreign flows have been negative. And whichever year the foreign flows have been negative, in the next couple of years, we get tremendous amount of FII flows. So keeping that in mind, our outlook for the liquidity situation of Indian equity market remains pretty positive. That brings us to the last topic, that is valuation. Today, if we look at the price to earnings ratio of Nifty 50 is between 19 and 20. If we look at the average between 2016 to 2021, the average was pretty close to 27. So from that perspective also, the valuation perspective also, Indian equities are looking attractive. So if you look at the all three longer term driver of Indian equities, fundamentals, liquidity flows toward the equity market, and equity valuation, all three are supportive. So our view is that India, if the global equity market corrects, India will also continue to correct in the near term. But as soon as the global economic situation starts normalizing a bit, the equity market will rally back and India will rally more than others. That's it from my side.